Thanks for joining us. My name is Brian Kem, and I'm with Frugal Fortunes. Today, I'm going to be discussing the stock market, and more specifically, the coming stock market crash. We've been in the longest U.S. bull market in history, and there's a lot of indicators pointing towards a decline, which I'm going to go through here in a moment. But first of all, I would really appreciate it if you hit that like button down below and also the subscribe button. I have probably close to 0 subscribers right now, but I hope to put out a lot more content in the future. All right, so stock market crash in 2020. I predict about an 80% probability of that happening. And once again, importantly, I think showing you how to prepare your portfolio is key. I take a play right out of Warren Buffett's playbook. All right, we're going to jump into those 6 indicators here in a second, but first I want to say that standalone, they're not all perfect indicators, but when you combine them, it kind of starts to form a story, and we're a lot closer to a stock market crash than we have been in previous years. So the first market indicator is one of my favorites. It is the yield curve inversion. It sounds complex, but during times of, when economic fear is rising, investors will put a lot of their money into U.S. treasuries or U.S. Government debt because they know in times of uncertainty, that's a safer place to keep their money. And with the yield inversion, investors are uncertain about the short term, so they're more likely to put their money into 10-year or longer term U.S. treasuries. So what's actually happened is all that demand has pushed down 10-year yields, and short-term yields have gone higher, so you can collect higher interest on a 3-month treasury than a 10-year right now, which in my mind is just ridiculous. So the chart that you're seeing on your screen right now, it shows the 10-year minus the 3-month treasuries. Every time it drops below 0, a recession follows within about a year and a half. The past recessions are shaded in gray. And last month, it dropped into negative territory. This is a strong indicator that we might be headed for a stock market crash in 2020. It's kind of a scary chart. Second stock market indicator is the stock market to GDP. This is one of Warren Buffett's favorite metrics. It shows total stock market cap to US GDP, and after the long bull market, stocks to GDP are at an all-time high, as you can see in the chart. This Warren Buffett indicator has climbed from 93% in 2009 to about 154% this year. That's above the 2 previous highs, and it's not sustainable. Investors have pushed up company valuations. They're at historically high levels and have outpaced economic growth. Third indicator, price to earnings ratio. This is common in the investor space. Most people are familiar with the PE ratio. And it's a sign of market valuations. Over the long haul, it's even more useful after adjusting for market cycles and valuations. This improved ratio is called the cyclically adjusted price to earnings ratio, or the CAPE ratio. For the S&P, it comes in at about 30 and is over 45% higher than the long-term average. Although it could still continue to climb, it's well below the peak of the dot-com bubble. Either way, this ratio tends to mean revert as the stock market ebbs and flows. It's not a great predictor of stock market collapse, but it is a good predictor of future stock market returns. It also shows excessive optimism with investors in the stock market. I put together custom research on the price to earnings ratio, and you'll find a link to that in the comments below, so I do advise checking that out. Now, the fourth economic or stock market indicator is corporate debt levels. It's a little broad, but the Fed has pushed interest rates to such low levels that companies have leveraged up. They've taken on a lot more debt, and in this chart, you'll see that those two have moved in opposite directions. As rates have decreased, companies have taken on more debt. It continues to grow, but this will pressure companies when they need to, those that have over leveraged and they need to refinance. If rates start to tick up, that's going to make it harder for them, and that's going to send waves throughout the economy, downward pressure. The fifth indicator is the housing market. This affects many Americans and families. Cheap debt has fueled many home sales, and many home buyers have borrowed above their means. This demand has pushed home prices back above pre-crisis highs. Now, it's not as toxic as the last run-up, but it's still a concern. Lending standards in the CDO market, or collateralized debt obligation market, are more controlled this time around. Although the housing market is still overextended and due to the Fed's manipulation of interest rates. Number 6, true unemployment. The government reported unemployment rate is near record lows. That sounds great, although it's not sustainable. In this chart, you can see clear trends. Anytime unemployment drops to low levels, a recession isn't far off. Optimism from that booming market spurs companies to overhire. Once again, it's not sustainable like the previous metrics. Unemployment is a good indicator of market health, although there's a growing divide not reflected in these government numbers. True unemployment is climbing, and for more insight, I recommend checking out my research on universal basic income. It's a unique view you're not going to find anywhere else, and it's in the comments below, so please do check that out. Bull markets don't die of old age. There has to be a catalyst that sparks the implosion. In 2008, we saw the housing market collapse. This led to banks collapsing and it sent shockwaves throughout the economy. Now, what's going to be the catalyst for the 2020 crisis? I don't know with certainty. To be honest, it's a bit of a fool's game to try and predict it. But two potential things might be trade wars and tariffs. With trade wars and tariffs, there's a lot of press on that recently, and there's also bipartisan support. So with the potential re-election coming up, I don't see any backing down on the tariff or trade war situation. And to see some kind of the historical impacts of tariffs and how they're a net negative to the global economy, you can look into the Smoot-Hawley Act or Smoot-Hawley Tariff Act of 1930. It helped worsen the Great Depression. The international markets declined by about 66%, and economists kind of attribute those tariffs back in the day to that decline. Now, what do all these negative indicators mean to you? If a collapse is coming, how do you prepare? Well, how I prepare, I take a move right out of Warren Buffett's playbook. As a bull market gets long in the tooth, it's harder to find companies at reasonable prices. As a result, it's not good to invest in many of those companies. You'll see with Warren Buffett or Berkshire Hathaway, the company he manages, the cash position has climbed from about, I think, 30 billion to, that was back in 2008, 2009, to over 100 billion today. One of the world's best investors is having a hard time figuring out where to put his money. As a result, I've kind of followed suit, and I've been hesitant to deploy a lot of my cash reserves. I'm waiting for better buying opportunities. And in the meantime, I'm putting my money into what we discussed briefly before, which is 3-month treasuries. I'm collecting close to about a 2.4% yield. That's annualized on 3-month treasuries, rolling them forward every 3 months, waiting for a collapse. Timing the market is a fool's game. No one can do it. Some of the world's best investors can't do it with certainty. That's why I only put about a 80% probability of a stock market crash in 2020. But in the meantime, I'm at least just barely beating inflation. And then when a collapse does happen, I'm going to deploy all that capital, get into stock market long term, and from there, I'm going to let it ride. I'm in it for the long haul. These positions, unless I'm making adjustments for tax situations, I'm not going to change a thing. And I'm going to let my long U.S. equity positions ride for hopefully 30, 40 years, maybe live off of the dividend income at some point. But that is one way other people can prepare. I'd love to hear your thoughts. If you listen to me to this point, I hope you found something useful in this video. I provided a lot of information. I'd really appreciate it if you hit that like button down below. And if you haven't already, which you probably haven't because I have close to 0 subscribers, hit that subscribe button. I really appreciate it, and I look forward to seeing you next time.